Hello and welcome to this update on the loan charge. It's the 13th of January 2020. Just before many of us shut down our PCs for the Christmas break, our new Conservative Prime Minister announced changes that we made to the loan charge in the Finance Act 2020. The loan charge was first announced in December 2016 as a measure to impose income tax on historic disguised remuneration income arrangements involving loans to employees made after 5th of April 1999, which had not been repaid as at 5th of April 2019. The loan charge itself is immensely complex. I don't explain it here. The main point is that it treats outstanding loans at 5th of April 2019 as earnings for the tax year 18-19. And so the loan charge and the latest announcement affects tens of thousands of individuals who are preparing their tax returns for the tax year to 5th of April 2019. I will explain briefly the background to the enactment of the loan charge, the independent review published in December 2019, which was called for on 19 September 2019, following comment by Boris Johnson last June, and the new PM's response to the review, which was published on 19 December 2019. To properly examine the background would take a whole textbook because it was introduced against a background of 30 years of tax planning, frequent changes in the legislation and case law over that period. I don't have time in this webinar to do that, but what I will do is take a look back at some of the key moments in that time which are relevant to the loan charge, starting in the 1990s. So these schemes were already being widely used in the 1990s in the form of employee benefit trusts, or EBTs for short. EBTs became widely used by banks and other financial services companies and other employers generally to pay bonuses to highly paid employees, including, for example, professional footballers. The arrangements became very nuanced. Put simply, the employer would make a contribution to the trustees of a trust for the benefit of employees, and the trustees would make payments by way of loans to those employees. In those days, employers were claiming a corporation tax deduction for a debit in the profit and loss account in respect to the contribution to the trust, and not paying income tax or NIC on contributions or on payments by the trustees to the employees in the form of the loans. This possibility arose because of Section 37 of the Finance Act 1989, which changed the basis of Schedule E assessment, as it then was, from the year in which emoluments were earned to the year in which they were paid. The types of arrangements used can be seen in cases such as McDonald and Dexter Accessories, which was heard in the House of Lords in 2005. There, the question in the appeal courts was not whether the loans were chargeable to income tax on the employees, but whether the employer could obtain a corporation tax deduction in the tax year in which the provision was made in the accounts. Section 43 of the 1989 Act was intended to prevent employers obtaining a CT deduction before employees were paid. And that section applied broadly where relevant emoluments would otherwise be deducted in calculating profits chargeable under what was then Schedule D, and the emoluments were not paid within 9 months after the end of that period of account. Where it applied, then the deduction would be disallowed and only allowed in the period in which emoluments were paid. Relevant emoluments were defined in subsection 10 as emoluments which have been allocated in respect of a particular office or employment, or generally in respect of offices or employments. And subsection 11 extended this rule of non-deductibility to potential emoluments as defined by section 4311A as amounts or benefits reserved in the accounts of an employer or held by an intermediary with a view to their becoming relevant emoluments. So the question in Dexter was whether certain payments made to an EBT were potential emoluments within that definition. The taxpayer won in the Special Commissioners and the High Court, but lost in the Court of Appeal and the House of Lords, where Lord Hoffman held in agreement with the Court of Appeal that the amounts were potential emoluments as defined because there was a realistic possibility that the trustees could use the amounts to pay emoluments. So that was found to be sufficient for the amounts to be held by an intermediary with a view to their becoming emoluments. That case put a large dampener on employers claiming a corporation tax deduction. And in the meantime, by Finance Act 2003, the government had also enacted further anti-avoidance rules to prevent a corporation tax deduction. Scheme promoters nevertheless came up with other schemes to try and obtain a corporation tax deduction for payments to EBTs, such as family benefit trusts. So at that time, there appeared to be a game of cat and mouse surrounding the corporation tax deduction, but HMRC had not made any successful assessments to income tax or determinations for NIC. In the Special Commissioners in Dextra in 2002, HMRC had argued that the loans to the employees were chargeable as remuneration, but they lost that point. They also lost the argument that the money contributed to the trust and allocated to the sub-funds amounted to a payment of emoluments, and only the corporation tax point was argued on appeal. So HMRC didn't assess contributions or loans to income tax at that time either. And as we know from the Rangers case in the Supreme Court, which I'll come on to in a moment, these contributions should have been taxable in the year that the contributions were made. And yet the loan charge, as originally enacted in 2017, could have applied to the loans in Dextra and other EBTs from that time, which were made from 6th of April 1999. It seemed to me to be a second bite of a cherry, which has been resurrected from the earth into which it was dissolved 15 years ago. HMRC knew there was widespread use of EBTs in the 90s and early noughties. They were fully aware that most of the banks and large employers were using EBTs back then, and they also knew close companies were using them as standard planning. Large employers had customer relationship managers, CRMs, at HMRC who they discussed their tax with in real time and who gave them a risk management rating. These large employers gave full disclosure to HMRC of the use of EBTs, either in those meetings or under DOTAS when it came along. The scale of the use of EBTs was huge. So the employer in Dextra was Phones for You, and the contribution in that case in 1998 alone was 2.75 million. Thousands of owner-managed businesses were putting in amounts of 6 or 7 figures each year. The large financial institutions were known by HMRC to be putting in tens and in some cases hundreds of millions of pounds in bonuses each year. HMRC again tried to challenge the income tax position in the case of Sempra in the Special Commissioners in 2008. And there, HMRC unsuccessfully argued that the payments to the EBT were earnings. I'll come back to these cases in a moment because the Supreme Court considered Sempra a decade later in 2017 in the Rangers case. But throughout the 90s and noughties, variations on EBTs were being used and the income tax position had not been successfully challenged by HMRC. These were perhaps the most widely used loan arrangements at that time. The first legislative clampdown in relation to income tax on these arrangements came in Finance Act 2011 in the form of Part 7A of the Income Tax Earnings and Pensions Act 2003, known as the disguised remuneration legislation. This was announced on 9th of December 2010, and we'll see in a moment this is a key date in the government's response to the review of the loan charge. There was also an EBT settlement opportunity made available at that time by which the government tried to encourage employers to wind up their EBTs. But the Finance Act 2011 clampdown didn't stop promoters coming up with new schemes like the ones you will have seen in the press, including arrangements like the K2 scheme involving Jimmy Carr and later iterations of that. The schemes generally have in common that they involve the remuneration of workers by way of loans, not from their employers, but from a third party. The expectation in many cases was that the loans would never be repaid, and the intention was that the loans would never be subject to tax at all, so that individuals spent the loans without worrying about income tax, national insurance, or repaying it. So most individuals don't have the means to repay it or to pay income tax on the amounts paid to them, or it would be extremely difficult for them to do so. Finally, by way of background, I must mention the Rangers case, which means that since Finance Act 2011, the case law on the income tax position has also changed dramatically. So the Rangers case is the Supreme Court decision in 2017 in RFC 2012 PLC, in liquidation, formerly the Rangers Football Club PLC versus the AG for Scotland. In that case, the Supreme Court held that in general there is a liability to income tax on earnings arising from an employment, not only where the employee receives or is legally entitled to receive the earnings, but also where a third party, such as trustees of an EBT, receives the earnings with the agreement or acquiescence of, or otherwise by arrangement with the employee. So where they are in effect redirected by the employee. That's paragraph 58 of the Supreme Court decision. So that's the argument which HMRC had lost in the Special Commissioners in Dextra and in Sempra, which the Supreme Court held was wrongly decided. There are some cases from the late noughties still making their way through the courts where HMRC have been able to rely on the Rangers case. So the case of Landed Property Limited and others versus HMRC, decided in 2017, involved an EBT and subtrust implemented a decade earlier in 2007. The upper tribunal, Mrs. Justice Falk, applied the Rangers case and noted the similarities to the facts of Sempra. On that basis, she decided that the payments to the trustees, which were allocated onto subtrusts for the benefit of employees, were earnings at that point. So, according to the case law on EBTs, there should have been an income tax charge on earnings in the year of contribution to the EBT, which is generally when the allocations to subtrusts would occur. And yet, the loan charge, as originally enacted in 2017, could have applied to the loans from EBTs made from 6th of April 1999, notwithstanding that HMRC are well out of time to assess that income. So this is one of the reasons why the loan charge attracted significant criticism from various sources, including MPs, and an independent review into the loan charge led by Sir Amyas Morse was announced on 19 September 2019. So what are the key points from the review? Well, the review would consider whether the loan charge was an appropriate response to tax avoidance behaviour and whether the changes made to support individuals in meeting their tax liabilities had addressed legitimate concerns raised. The government's response to the review was published on 19 December 2019. HMRC issued updated guidance to accompany that on the 20th of December 2019. Now, the government's response does not go as far as the review proposed. The headline changes to the loan charge are that loans made prior to 9 December 2010 will not be caught by the loan charge. So that's the date when the disguised remuneration legislation was announced. Other loans made after that date but before 5th of April 2016 are not caught, provided that they were disclosed to HMRC and HMRC failed to act upon the information disclosed to them in time, for example, by opening an inquiry. For individuals not sure whether they're taken out of the loan charge, there are options to either file the return and include an estimate of the loan charge by 31 January 2020, which must then be amended by 30th of September 2020, or they can delay the filing of their self-assessment return until after Finance Act 2020 and before 30 September 2020. So provided an accurate return is filed by that date and time to pay arrangements have been agreed, there shouldn't be any interest or penalties. There will be a settlement opportunity until 2020 for those now outside the loan charge, but where HMRC has protected its position and can recover the tax. It's important to note here that many schemes involved an offshore element or transfer, and Finance Act 2019, Section 80, extended the time limits for HMRC to issue assessments to 12 years, where it would previously have been 6 years for carelessness or 4 years under Sections 36 and 34 of the TMA. That extension applies to tax years 14-15 and 15-16 onwards, respectively. There is provision for spreading the outstanding loan balance over 3 years in order to prevent artificial increase in the tax rate for a particular year. So this change is estimated to affect around 21,000 individuals. All individuals who have to pay the loan charge will only be asked to pay up to half their disposable income each year and a reasonable proportion of their liquid assets. So no one should have to sell their principal residence or use their pension fund for payment of the loan charge. HMRC has agreed to fund an external body to provide independent advice to lower income taxpayers who are discussing payment arrangements and debt collection with HMRC. HMRC will refund amounts already paid to them in settlements by way of voluntary restitution in relation to the periods where the loan charge no longer applies. But as ever, in relation to all of these changes, the devil will be in the detail, and the new legislation will have to be closely scrutinised when it's published. Of particular interest will be what constitutes full disclosure for the 2010 to 16 period, whether HMRC protected their position by opening an inquiry or issuing a valid assessment in time, and also the mechanics of the refund of voluntary restitution. So many individuals will no doubt be delaying the filing of their tax returns for 1819 until after the Finance Act. HMRC have emphasised that the changes to the loan charge will not impact existing inquiries or assessments for historic periods. They state these will still need to be resolved either through an extended period for settlement with HMRC or through litigation. The government is investing in a new HMRC team to conclude inquiries and bring in the tax due from people who have in the past used disguised remuneration schemes and other forms of tax avoidance. The review notes that disguised remuneration schemes are still being used. The government has stated that it will reflect on the most effective method to tackle these and will announce further action at the budget. So it's really a case of watch this space and take advice.